Hey guys, hope you are all having a fantastic day so far. Today we are going to talk about various important developments taking place across the entire global sector, as well as hone in on commercial real estate, which for some reason is not getting enough attention from the corporate media, housing real estate, the defaulting crisis going on and some other things. It's been a while since I put a video for you guys, but I have 3 whole videos for you for the remaining days of the week. My schedule is clearing up, so I should be pumping 2 videos per week from now on. Before we get started, let me invite you all to my Discord. We have been having a pretty consistent performance over the past few weeks. If you are looking to add a solid income via day trading, there is no better place than to join our Discord. Even more so, if you are not a fan of day trading and are looking to derive profits in a more passive manner, we have passive income alerts where we tell you what options to write every Monday and you cash out ASAP. Members have been making consistent profit through this over the past months, and there isn't any reason you shouldn't. We have a 7-day free trial for everyone. Discord is already free to join. Come check us out when you get the chance. With that said, let's get started. For the past month or so, markets have been increasingly bullish. Left and right, I saw both analysts and retail investors comment on optimistic outlooks of a pause to rate hikes and cooling inflation. Less panicked investors have led a frenzy these past couple of weeks in what was an attempt to price in a bullish set of catalysts that took place last week, but the Fed shocked everyone when they said and reinstated that their fight against inflation isn't going as they want. In fact, unbeknownst to many, the Fed recently came out and said that it's hard to figure out what exactly is slowing the economy right now. That's a huge admission that I don't think markets are taking in seriously, because if the Fed themselves cannot even figure out the leak in the ship, what makes everyone so certain that the worst is past us, or that the economy is headed for a full recovery in the next couple of months? Delusional would be an ideal assertion to make. Let's talk about the fact that the Fed's presidents are signaling more interest rate hikes. A group of Federal Reserve officials are indicating the possibility of another interest rate hike in the coming months due to signs of inflationary pressures in the U.S. economy. In their recent speeches and interviews, these policymakers have emphasized a hawkish stance, acknowledging the recent decline in inflation while warning that it remains too high to pause the central bank's tightening efforts. During a speech to the American Gas Association in Florida, St. Louis Federal Reserve President James Bullard expressed his belief that raising the policy rate is necessary to effectively curb inflation and bring it back to the target level. He mentioned the likelihood of 2 more rate hikes this year, although the exact timing is uncertain. Bullard has consistently advocated for taking action sooner rather than later. Previously, investors speculated that the Fed would pause its rate hikes at the June meeting after approving the 10th increase in May, resulting in the federal funds rate reaching its highest level since 2007, ranging from 5% to 5.25%. However, the hawkish remarks from Bullard and Minneapolis Fed President Neel Kashkari have raised concerns about an additional rate hike in June. Kashkari, a voting member of this year's policy-setting Federal Open Market Committee, stated that future rate hikes are still on the table, even if officials decide to pause in the upcoming month. Kashkari described the decision as a close call, weighing the options between raising rates again in June or taking a break. He emphasized the importance of not signaling the end of the tightening cycle, stating that skipping the June hike would mean gathering more information. He pondered whether the rate increases could resume potentially in July. According to data from the CME Group's Fed Watch tool, the probability of a 0.25 percentage point rate hike in June rose to 26.8% on Monday afternoon, compared to 17.4% the previous week. Dallas Fed President Lori Logan also expressed her view that inflation remains much too high, and is not cooling down rapidly enough to justify a pause in the tightening cycle next month. While acknowledging some progress after raising the target range for the federal funds rate in the last 10 FOMC meetings, she suggested that skipping a meeting might become appropriate based on forthcoming data, but as of now, they have not reached that point. Despite inflation easing from its peak of 9.1%, it still remains significantly above the pre-pandemic average and surpasses the Fed's 2% target rate. Additionally, the labor market remains tight, with unemployment recently reaching its lowest rate since 1969 at 3.4%. Quincy Crosby, the chief global strategist for LPL Financial, commented on the recent statements by Federal Reserve officials, highlighting their commitment to restoring price stability. He emphasized that if inflation doesn't cooperate, the Fed is prepared to raise rates once again to fulfill its mandate. So all in all, Federal Reserve officials are signaling the possibility of further interest rate hikes due to underlying inflationary pressures. Despite some recent declines in inflation, policymakers are hesitant to pause their tightening campaign as inflation remains high. The market is now anticipating the likelihood of an additional rate hike in June, but what's most interesting is that the markets have remained significantly bullish even with the possibility that the US defaults on their payments. For weeks, the United States has failed to produce an agreement between parties, and we are nearing a dangerous date where we could begin to fail making payments. This is something we have actually gone in great detail since early this year, and though Americans are still more optimistic that a deal will be made before the due date, we have gotten dangerously near the point of things breaking apart. Americans not being able to pay their bill would be a nightmare scenario unlike that we have ever seen before. It would be a cataclysmic event with dramatic fallouts for the entire global financial markets and have immense consequences for global growth. Already, the United States have shown that future growth is already affected due to inflation. I know many of you don't even understand what the debt ceiling is, so let's quickly go through the basics. As you all know by now, thanks to the scary headlines in the news, time is running out to avoid a significant default on the nation's debt, as Treasury Secretary Janet Yellen warns that the U.S. could exhaust its funds to pay its bills by June 1st. Negotiations between the White House and Republican lawmakers has broken down, creating an impasse. While breaching the debt ceiling may seem abstract, financial experts caution that it could have various adverse effects on Americans. Here's what you need to know. The debt ceiling, determined by Congress, represents the maximum amount of money the federal government can borrow to fulfill its financial obligations. Raising the debt ceiling does not authorize new spending but allows the government to finance its previously approved commitments, such as Social Security payments and military salaries. Jacob Channel, a senior economist at LendingTree, aptly compared failing to raise the debt ceiling to going to a restaurant, browsing the menu, realizing the costs when presented with the bill, and then realizing you cannot afford to pay. The U.S. has never breached the debt ceiling, although it has come close on several occasions, notably in 2011. When lawmakers agreed to raise the debt limit just before the nation would have exhausted its borrowing capacity. This event led to Standard & Poor's downgrading U.S. debt for the first time, resulting in a 17% drop in the stock market, with the Dow experiencing significant losses during the crisis. A default on the debt would have a profound impact on global financial markets, prompting many investors to sell off stocks and bonds. Prices would plummet, although the exact severity of the consequences remains uncertain since the U.S. has never faced such a situation before. If a breach occurs, Tony Roth, chief investment officer at Wilmington Trust, warns of significant disruptions in U.S. financial markets, causing widespread discontent. Experts suggest that Social Security recipients may experience delays in receiving their payments, leading to financial hardships, especially for seniors and individuals heavily reliant on Social Security as their primary income source. Janet Yellen stated in April that if the U.S. defaults, it is unlikely that the federal government would be able to issue payments to millions of Americans, including military families and Social Security beneficiaries. Federal workers and members of the armed services may also face delayed or missed payments. The U.S. government would need to prioritize payments with the remaining available funds, potentially choosing to prioritize interest on bonds to avoid a debt downgrade instead of paying federal salaries. Patrick Gorley, an associate professor of economics at the University of New Haven, explained that the government could decide not to pay government employees during such a situation. Medicare and Medicaid could also experience disruptions, affecting healthcare services for older Americans and low-income households. Nearly half of the U.S. population, approximately 158 million people, are enrolled in these programs. Experts advise individuals to seek healthcare services promptly, warning against delaying medical procedures should a breach occur. A default would likely increase the overall borrowing costs, resulting in higher interest rates, including on credit cards. This would further burden consumers who are already grappling with record-high credit card annual percentage rates. With credit card debt reaching nearly $1 trillion, a default could exacerbate the situation. Buying a home could become even more expensive if a default forces the Treasury Department to pay higher interest on bonds, subsequently leading to increased mortgage rates and borrowing costs. According to Zillow, mortgage rates could surge to 8.4% by September, making mortgage payments 22% more costly and potentially freezing the real estate market. Even a short breach of the debt ceiling, lasting a week or less, could push the economy into a recession, as stated by Mark Zondi, chief economist of Moody's Analytics. Zondi predicted that such a breach would be enough to undermine the already fragile U.S. economy. If the breach extended beyond a week, the U.S. could face a deep recession, resulting in the loss of 7.8 million jobs and an unemployment rate of around 8%. Given the widespread disruption affecting those with 401k accounts and reliance on government programs, the ensuing outcry would likely compel the White House and Congress to swiftly return to the negotiation table and find a solution. Experts believe that if a default occurs, the disarray would be so significant that it would not last long, as the intense pressure to resolve the situation would force a quick resolution. Roth of Wilmington Trust suggests that it would likely only persist for a couple of days. As you all can see now, this would be a disaster of unprecedented magnitude, and though it is still likely that a deal will be made, we are slowly getting to that deadline. When I warned about this months ago, people were telling me I was being too pessimistic, that things would be solved by then, and now here we are, with no deal in sight. I'm not trying to create panic, but I have been carefully observing how politics is affecting the ability for Congress to get their act together, and so far, I have been right in asserting that the political divide in Washington is so strong that it impedes real progress. There's not much left to do but wait until the first or second week of June. If by then no deal has been made, take a look through the markets and go see what red really looks like. This will be a historical event studied in every school for the rest of history so long as the United States remains standing, so make sure to take some selfies to show your grandkids. Let's now talk about real estate, which seems to be everyone's favorite topic on this channel. Last month, there was an unexpected increase in new home sales in the U.S., reaching the highest level since March 20, 22. Additionally, prices of these homes declined, indicating that builders are benefiting from the limited inventory in the resale market. According to government data released on Tuesday, purchases of new single-family homes rose by 4.1% to an annualized pace of 683,000 last month. This figure was revised downward from the previous estimate of 656,000 in March. Economists surveyed by Bloomberg had predicted a reading of 665,000. The median sales price of new homes experienced an 8.2% drop compared to the previous year, amounting to $420,800. This decline represents the largest decrease since April 2020 and reflects the increased demand for more affordable houses. New home sales have been on the rise since reaching a low point in mid-2022, illustrating how builders are taking advantage of limited listings in the resale market. This gradual increase in demand suggests that residential construction is having a less negative impact on the overall economy. Now, let's stop for a minute and let's clarify things quickly. The new surge in home sales wasn't due to an increase in buying or interest by normal average Joe citizens like you and me. Oh no, this increase was led by institutional investors quickly buying up the housing. As I have stated in the billion videos I have made regarding this subject, builders are benefiting big time by amping up their prices because of the limited inventory there is in the resale market. Remember, big money, which is Wall Street and friends, are paying for politician campaigns in order to have them enact laws that prevent rapid and adequate expansion of housing in needed sectors. As we know, there is a concentration we are seeing as millions of people move to cities. As a result, Wall Street and friends are quickly buying up all the housing while doing the most they can to limit construction of more housing so that they can artificially elevate the rental pricing they give tenants. That's why rents went from being about $1,000 or so in certain cities to over $2,500 per month in a matter of 2 or so years. While you struggle to put a hot plate for dinner at the table because you have to shell out an extra $500, remember BlackRock and friends are sitting comfortably looking to net billions in extra revenue per year. You will own nothing and be happy. As I was saying, despite higher mortgage rates compared to the end of 2021, investors have shown interest in homebuilder shares due to the scarcity of existing home inventory. Builder sentiment is also at a 10-month high, reflecting increased optimism about sales expectations. The South saw a substantial jump in sales, rising by almost 18% to the fastest pace since early last year. Purchases in the Midwest also increased to a level not seen in over a year. As of the end of last month, there were 433,000 new homes available for sale, which is relatively unchanged from the previous year. This represents a 7.6-month supply at the current sales rate, marking a one-year low. The number of homes sold in April but awaiting construction initiation, indicating backlogs, reached a more than one-year high of 155,000. Due to homeowners' reluctance to list their properties in a higher mortgage rate environment and builders working through backlogs to increase output, new construction is gaining a larger share of the housing market. According to Robert Dietz, the chief economist at the National Association of Home Builders, new construction now accounts for almost a third of the housing inventory. New home sales are typically considered a more timely indicator compared to purchases of previously owned homes, as they are calculated when contracts are signed. Separate data from last week showed that sales of previously owned homes fell to a 3-month low in April. It's important to note that new home sales data can be volatile. The report showed a 90% confidence level that the change in sales ranged from a 7.7% decline to a 15.9% increase. All in all, the economy is not looking that good. If you watched my last video, I told you to look out as the rich hoard historical levels of wealth during this transition, and here's the first clue of what's going to go down. Markets going up doesn't surprise me. As a long-term investor, I too understand that markets are forwarding-looking, so even as we continue dealing with inflation, they will begin recovering. After all, markets are the money storage for the rich, so you bet that's going to be the first thing to recover. However, what I do call for caution is for the unchecked optimism in the markets, which seems to be lacking a strong base and could be described as delusional. Personally, as I have said for over a year, I am waiting for midsummer to begin making long-term investment transactions. If by then the economy hasn't sunk due to a debt default, it will still be weak enough for me to begin taking long-term positions. Thank you all for watching this video. I got more stuff coming out to you guys tomorrow, so make sure to stay tuned. Join my Discord if you are looking to make income, whether it's passive or you are looking for good quality consistent day trading alerts with strategy and educational content. We have a 7-day free trial opened for everyone, come check it out. Have a great rest of your day and to the moon.